Welcome to the Let's Actually podcast interview series, where we speak to leaders in VC, venture building, and future technologies, and we discuss the current state and trajectory of their domains. Let's dive in. Good morning, good afternoon, and good evening to you all. Welcome back to the Let's Actually podcast. There's a really fun one for you today. We've got Matt Curtolo, who is a seasoned LP. He's been investing in alternatives for over 2 decades at a variety of organizations. He brings a diverse LP perspective to the table across a multitude of sizes of orgs. And most recently, he got his first taste of actually working as an operator for a fintech startup called Allocate. Looking forward to digging into the history and hearing more about your journey, Matt. Welcome.
Thank you, Andrew. Great to be here. Thanks so much for the invite. Looking forward to the conversation.
Yeah, very much so as well. We've chatted a few times, and every conversation I think we've had has been so insightful. I've been like, I wish we recorded that so we could share this information and perspective with the world. So really appreciate you hopping on. So why don't you share a little bit about who you are, what you've done, and what you're up to these days?
Yeah, absolutely. So as you mentioned in the kind introduction, I've been an allocator in private markets for the last 20 plus years. So the career has kind of taken me across a lot of different aspects of the business, across different size organizations, working with different types of LPs, investing in a variety of asset classes. So I started my career in 2004 at a firm called Hamilton Lane, which now is one of the largest global private markets investment managers, alternative asset managers. And there, it was earlier in the life of the company. It was a relatively small company at the time, but I was fortunate to be there through a very high growth period for the business.
Nice.
My first job out of school. So I got to really explore a lot of the different avenues. And I always say I was swimming in the deep end the entire time I was there, just kind of trying to get up to speed and learn an asset class that was still growing and also finding its footing, both with acceptance publicly or acceptance more broadly across institutions, but new strategies, new investment types, things like that were all popping up. And I would say the proliferation of managers too allowed for that as well. So I got to wear hats in the client service department, in the secondary investment side, in research, in the back office. So really got to learn all aspects of the business. And the clients at Hamilton Lane ranged from, university endowments to sovereign wealth funds and the largest public pensions in the US, and many globally as well. So great perspective, got to learn from some incredibly smart people. I then moved on to an outsourced CIO. So a different model. So think of the client type for a consultant like Hamilton Lane at the time was more larger institutions. The outsourced CIO model is really focused on small and mid-sized institutions, as well as individuals. The idea being you don't necessarily have the capital to hire an internal staff to manage all the processes that would come with an investment office and portfolio. So that was, I always said, get a little closer to the capital. So whether it was a $50 million private school endowment, a foundation, a charitable organization, or a family, and managing a diverse set of trusts within that. My role within the firm, we had these captive clients who had outsourced their entire investment program to us. And I was helping to manage the private equity program, which I ultimately took over. And that covered a lot of ground. So we had really latitude to look anywhere in the world at any alternative asset class. So awesome. That was, while empowering, also daunting. So
I can imagine.
We tightened that up a little bit more and really focused in on equity-oriented strategies. So buyouts, venture capital, and growth. And I think that was the first opportunity for me. It certainly wasn't a blank slate. The program had been around for about probably 15 years at the time that I joined. So there was a legacy portfolio, but the sort of fresh eyes mentality of being able to take what was really good from the past, but also supercharge it going forward. And also learn a lot about LP management. It was a fund of funds structure, so a commingled vehicle with, I think at the peak, maybe 150 or 170 different LPs within that. So it was had the benefit of a large organization to work with the client service, but it was my first opportunity to really talk about a vehicle that I had hands in building rather than, more of a service role. So that was a lot of fun from my perspective. Get involved with fundraising and building a lot of those primary relationships where I was the main point of contact. So awesome experience there. Spent 8 years, and then transitioned to again back. I always say it's a little bit of a pendulum. So Hamilton Lane was a bigger firm. Hurdle Callahan, smaller, focused on smaller clients, and then spent time at MetLife. So
Okay.
co-led the alternatives group within MetLife, which was managing the assets of the general account of the
Nice.
insurance company. So as you can imagine, it's a Fortune 50 company, been around for 150 years, life
Yep.
insurer, very large balance sheet, and that general account was sizable. I always used to say the alternatives piece was very small slice of a very big pie. So really, our portfolio was large and dated back 30 some years. So you
Oh,
had
wow.
the certainly the benefit of time, and obviously the teams had transitioned over the period of time. We had a large global team, so we had 13 people managing the alternatives portfolio at the time, and that really allowed me to focus in on certain areas. So one of the primary hats I wore was focusing on U.S. buyout investments, but really expanding my relationship set deeper into venture, and that kind of facilitated my transition as we follow the pendulum back to joining Allocate. So
Okay.
basically a fintech startup that was focused on bringing access to top tier venture to more of the masses. Now, not
Oh,
a
nice.
retail product, but more of a product for single family offices, for wealth managers, for ultra high net worth individuals who maybe felt constrained either by the friction of the process to invest
Hmm.
in these, maybe didn't have the wherewithal or the understanding of the asset class. So we're just a little bit gun shy to dive in. Or maybe they had done some things and it hadn't gone perfectly. So being able to provide both the conduit to invest and pull a lot of the friction out of the system, but also source interesting opportunities that would make sense within those types of programs and portfolios.
Awesome.
So that was, again, as a startup, having worked at places like a MetLife or a Hamilton Lane, where there was a lot of institutional history and infrastructure, the opportunity to really get my hands dirty from the ground level
Yeah.
was a lot of fun. The idea of kind of building a company as well as keeping my primary investor hat on was really appealing. Worked with a great team at my time at Allocate, and yeah, most recently I have been wearing a lot of different hats in a variety of consulting roles, working with both emerging GPs,
Okay.
helping them with their go to market strategies, and really positioning within what is a pretty challenging fundraising market. And then
Mm.
also working with LPs, leveraging my history in terms of portfolio construction, manager diligence, the opportunity to really do and see a lot of different things, and take advantage of the things that I've been able to see over the years.
Yeah. That's epic. And it sounds like a very exciting swing back and forth. Would you say that your trajectory is now heading back in the other direction? Do you see that you're working toward creating some sort of platform or infrastructure or like something of that larger scale to bring that taste back? Or are you really enjoying this more nimble, agile, higher impact, earlier stage work?
Yeah, it's a great question. Something I battle with on a daily basis. It's a good problem to have,
Yeah.
honestly. But uh, the flexibility and the interesting thing, if I look back at my career, that while they've been at different size organizations at different points in their life,
Hmm.
there was always an entrepreneurial lens that I was able
Yeah.
to overlay on a lot of this stuff, whether that was even at a place like MetLife, trying to enhance some of the processes, and optimize and revolutionize. Obviously, it's harder to do at an organization like
Yep.
that, where you do
Yep.
need a lot of collective buy in and there are a lot of
Yep.
processes in place. But even at a place like Hamilton Lane, where we were sprinting, and so that I think that's part of my DNA, which maybe I didn't realize until I actually was
Mm.
in my last seat. So
Interesting.
my expectation is it probably looks more like a collection of entrepreneurial activities versus diving into just another long term sort of more institutional looking role. But that's the aperture is wide. So as I consider a lot of these opportunities, that's kind of the place where I'm at now.
That's awesome. I do have a hypothesis in the back of my mind that I'll be watching over the years to come to see if you just start naturally building out the infrastructure that'll eventually be one of these longer term, larger plays, and somebody else shares their same story about being innovative within from the very start. Very cool.
Absolutely. Thank you.
Yeah, absolutely. Um, Gosh, there's a bunch of different ways that we could go with this. So you mentioned that you've been working a lot with emerging managers. So I'm going to get a little selfish for us and for the audience out there that's kind of diving in this. Maybe it's been doing it for a few years, or like we are a blend of that here, right? Chris and I are from the startup world and the
Mhm.
enterprise world and know how to build. Didn't have the venture experience, so we brought that in. So we've got some emerging managers with us. What have you been seeing in the market, either in current fundraising or current allocation space, that has been either, and I'll let you take anything that stands out to you
Mhm.
and run with it, a superpower, unfair advantage, something that's really appealing that they've been running with, or on the other end, a hindrance, a thorn in the side, something they're unaware of that's been a hindrance.
Sure. It, maybe starting at the macro, I think if
Sure.
there are emerging managers listening to this, and you probably have seen some of this, it is one of the more challenging market environments for
Yeah.
raising as an emerging fund today. I think if you look historically, there have been a lot more. There was an influx of emerging managers, certainly in 2019, 2020, and maybe even taking a step back. That the label emerging manager kind of is talking about a fund earlier in its life. It doesn't have to necessarily be a fund one, but a fund probably in the first 2 to 3 funds of its life cycle.
Mm.
So whether it was someone who was hanging a shingle when the market was really frothy and fundraising was a lot easier than it is now, and now is coming back to market looking to raise a second fund, or folks who are
Mm.
just materializing their strategy raising a fund one now, I think they're facing the same headwinds. One being the traditional allocators to emerging managers have been family offices, high net worth individuals. Part of the challenge
Mm.
for someone like a MetLife or a larger institution to be able to allocate to sub $100 million funds is just
Mm.
the efficiency of capital. When you're deploying multi-billion dollars a year, it's hard. So
Yeah.
that institutional class, it has never been the biggest participant in emerging managers, but those that have also been facing their own challenges, right? So if you look at the last handful of years, it's been a roller coaster for a lot of those folks, whether it be public market volatility. I think what we have prevailing now is this liquidity challenge that a lot of these companies have been staying private for longer. Public markets have been closed,
Mm-hmm.
the IPO window has been very difficult to get a company out there to generate significant liquidity. And M&A, while it's not been, it's starting to pick up in terms of activity, it's been a period of definitely muted activity and volume. So you have those things that are coming together. So the typical constituents who have backed these funds in the past are a little slower to deploy. So those are the headwinds I think that are
Mm.
being faced by these managers. Where I think your question about what's been working for folks and what's not been working for folks, it's kind of the same story. It, in my mind, when you're an emerging manager, I think first you have to understand this is a hard climb, right? Getting into this business is not for the faint of heart. I
100%.
think the conversion rate of a fund one getting to a fund four is in the teens. So just raising fund one doesn't mean you certainly are in business, but trying to get to that place where you've built a franchise rather than just a
Yeah,
fund,
exactly.
that's a big hill to climb. And the fundraising environment's just more challenging than many would think. So you have to have high conviction in your strategy. I think most managers do, particularly most fund ones. They come from a place where they've identified a particular problem, where they have a particular skill set that they think can be applied more broadly. I think where the challenge comes in is those that try to deviate from that a little bit. Kind of
Mm.
going where the market's going. I can tell you, you know, 3 out of 5 or 3 out of 6 funds that I see have all started to include ideas about AI in their pitch. Again,
Mm,
that's perfectly reasonable. I do think
sure.
that's a trend where you can apply within almost any strategy and should be looking at applying it in any strategy. But in most cases, these are folks, the initial pitch was more about that. What is that problem? What has my experience showed me about this problem that I feel like I am particularly differentiated to be able to solve that? I
Mm,
think that's where you get resonance with a lot of these groups that are still allocating to the space. You
hmm.
have someone who can look at your strategy. We used to talk about this idea of GP thesis fit, right? It's the right people at the right place doing the right thing, right?
Got
So
it.
it's a market overlay on top of that. It's a strategy that you've chosen, and it's your own background all interplaying together. And if without that, it's not to say you have to have all three of those all the time, but I think the people and the
Sure.
strategy have to very much align. And that's where I think you do see some resonance. Again, I wouldn't say it's easy for those folks, easier. And then the biggest challenge is the folks who come in with, not to pick on a particular example, but folks who are spinning out of larger VC funds, saying, I've seen how it works, and I'm going to try to do it a different way. There will be success there, right? We can dig in as an LP and an allocator. We look at all the intangibles as well. With an emerging fund, there's very limited track record, so we want to
Makes sense.
see how you operate, how you execute, and do a lot of the squishy qualitative type reference calling and things like that to understand. But making sure, I guess, to put a bow on it, making sure you have high conviction in your strategy, it aligns with your skill set and what you've been doing, and it also has resonance with the current market. So I think none of those things are exclusive, but trying to align yourself on those ends at least gets you in the door with a lot of folks. Because if allocation dollars are short, the
Yeah.
likelihood that you're going to be able to pry your way in without something that looks either differentiated or as a better alternative to what's out there, I think it's just a bigger challenge.
Love that. And you mentioned something on a call to me recently when we were chatting where you said it seems that in general, and it seemed to be a hint of this happening, that the purse strings are starting to loosen. Where are you seeing that? What are the signals that are giving you that inclination, and what do you think the implications of that are?
Yeah, it it's this is a slow moving asset class,
Yeah.
and
Yep.
even when you think about we the amount of data we're able to capture. Obviously, with private companies, the marks are done on a quarterly basis, so you don't
Yep.
have this constant feedback loop of how things are improving, how things are getting better. So a lot of it's anecdotal. I would say one of the biggest factors that constrained the last handful of quarters, year, was a lot around public markets and volatility there. So this idea of a denominator effect, where if the rest of your portfolio shrinks and your private markets portfolio stays the same, you optically have an over allocation or a higher allocation to the asset class than you initially had projected. Not because your private portfolio is doing anything different, but because your public portfolio is marked on a more regular basis and you're seeing a decline there. So as that stabilizes, I wouldn't say that's giving people, a sense of freedom to go out and throw money around, but it is
Yeah,
giving
of course.
people a little bit more sensibility to say, okay, we're comfortable now, where it probably falls in more the institutional bucket.
Okay.
Um, so taking that piece, and then really the individuals who, when you look back at at history, we've obviously had a lot of discussion about, are we entering a recessionary period as an economy? If you look back, some of the best vintage years are those that are coming out of periods of economic dislocation.
Mm,
So you have a little bit of that rearview mirror kind of, hey,
yep.
this is what happened during the last two or three of these. So let's allocate more. It's not an asset class to be that tactical, but I think that gives people a little bit more of a nudge to get moving. I wouldn't say it's. I think the purse strings are opening a little bit, but we haven't quite gotten back to what I would think would be a normal level.
And that makes total sense. And you also wouldn't expect or wouldn't want, I would assume, any market to just go from completely closed to completely open, because then you're going to get this really stark imbalance of flux. So it does make sense.
Sure.
Um,
And Andrew, 2021 was a great example. When you look at all the data from
oh yeah,
2021, it's a multi-standard deviation type event to historical trends. So I think a lot of people were anchoring to that vintage year as or that environment as
mm,
something that could be sustainable, and we will continue to have to deal with the I think the wreckage of what happened during that period, both funds that were raised that won't be able to raise again, and companies that were funded at levels that just aren't sustainable or
yeah,
don't match where their performance is going to end up. So I think there's a lot to wash out, even from where we are about 2.5, 3 years ago
yeah,
from that year. So I think I'd love to say that lessons are learned from these periods. It seems like there's a new lesson learned during every one of these. But I hopefully, to your point, you don't see this huge spike based on a lot of new entrants or any of those sorts of things.
100%. Do you have anything top of mind that you look out for, either as a warning sign of caution as to not contribute to that, or on the other end, a signal of opportunity that others might be missing because of that caution that they're taking?
Yeah, it's I'll answer it in two ways. I think
Sure.
the first part of this is back to a comment I made earlier. It's like the idea not to be tactical is
Mm,
really try to rein that in. We have a lot of conversations about the illiquidity of the asset class being a feature or bug. And the reality is not being able to pull your money out at the first sign of distress is actually a good thing.
yeah.
I read something last night as Fidelity had posted something. It was whether it was true or not, it definitely resonated. But the two constituents who had the best performance in their stock portfolio were those that were deceased or those that forgot their login information. So it's one of those things where just leave it alone. That's really a better mentality for the vast majority of folks trying to be an active trader in the public markets isn't going to benefit you. And the
Yeah.
private markets, when you take that away and you can think really with a long-term perspective, that's something that I think really comes in. So not ignoring what's happening in the broader markets, but understanding your own goals and where you want to get to longer term, and applying a 3 to 5 to 7 year time horizon to that. Obviously, changing along the way,
Sure.
but really with that longer term mentality in mind. So I think you do start to see, I guess the other answer to the question is you do start to see some of this, uh, some of this snowball starting,
Yep.
where I think you do get a lot of momentum as certain things happen, right? From an IPO perspective, we thought we were there. I think it was the Klaviyo IPO that a lot of people were looking at as potentially a
Hmm.
watershed moment to open up, but we realized that was a pretty special company at the time that it went public from a fundamentals perspective.
Yeah.
It hasn't really materialized into this huge wave of IPOs coming that may then set something up for other funds to continue to push that out, solving some of that liquidity crunch. Uh, and you also see it, I think, in other places where you have some of these events that get the momentum started, and then you'll see that happen. We haven't had a lot of them yet. I think we're starting to see the green shoots, but not quite there yet.
And thinking about these longer timeline perspectives, um, there was a very hot topic that you planted the seed with, and it was great that you surfaced it. So with the recent Carter report that came out, you wanna share a little bit of context about that?
Absolutely, yeah. So Carta put out a VC fund performance report recently over the last few weeks. And I think one of the things, if we take a step back, trying to get accurate and complete performance information in private markets in general is challenging. venture as a market, I think even more challenging. And then when you think about the emerging and small managers,
Hmm.
even a layer deeper. But Carta is in a unique position in terms of their business model and what they have access to, given their service, to be able to give us a lens into a different part of the market. I've never been one over the course of my career to say, we're just going to use this one data point and that captures the market. Unlike in the public
Yeah,
markets, you just
exactly.
don't have the transparency. And there are a lot of great service providers and great universe providers out there that are aggregating data where maybe it's capturing a percentage of the market. So looking at all of those in concert and
Yep.
seeing where certain data sets are more robust, less robust, gives you at least some insight into what vintage year and relative performance will look like. But this Carter report, particularly for our topic today, right? I mean, as you think about VC funds, they have a particular insight into that. What the data shows, and granted, it only goes back to 2017. It raised a lot of flags for people, and I think it was done without context. So people were sharing different charts, and this happens a lot.
Yeah.
With is this bad? Is this good? What does this mean? Particularly the chart around DPI. That was one that flew around VC Twitter for a number of different posts and different perspectives on it. What it showed was basically, and I think one of the tweets in particular was, you know, funds that are 5 years old haven't distributed anything yet, something to that effect.
Mm.
And should we be nervous? I think maybe not. But when you look at a single data point without context, it's hard. So thinking about, are you investing in venture for your capital be returned in 5 years, or a portion of your capital be returned in 5 years, particularly at the early stage? The gestation period for a lot of these funds and companies is a
Hmm.
lot longer than that, right? And
Hmm.
you can almost think of it as a contraindicator if capital's coming back in the early years, but for, I would say, an outlier type event where there is a big exit or there's something where you can take
Yeah.
a lot of chips off the table, the natural path for these companies is going to be longer than that. And the winners take a long time to develop, and the compounding happens in those last handful of years. So, all being said, it's a great report. I would advocate for people to take a look at it and review information that covers a data set that may not be broadly available. But taking each of those data points with some context, making sure that it's not good or bad, but just something to put into your toolbox as you try to analyze historical performance and maybe project out what you expect for future funds.
Yeah, 100% love that. And then that also led to kind of the consideration of, like you were alluding to, or hinting to, I should say, the expectation of returns, those timelines that are associated with that, especially in the earlier stages. I had a conversation with um, someone who represents a fund, and they're kind of even in the DoD space. And their whole basis of the pitch was they're playing a numbers game. Like that was leaning into the advantage of their perspective, as they're just deliberately quantitative. And the DoD flavor to that is the inclusion of like this non-dilutive funding. But there's this interesting contradiction that's not considered, which, one, hard tech is hard. Secondly, especially with the things that might go the route of um, dual use or these military or private applications, the timelines tend to be a lot longer to get stood up, um, even even with the extra support and capital. So I've kind of heard this other play, and they're shooting for exits. I think like 2 to 3 years or something like that, um, which to me is mind boggling. I've heard those stats being pushed maybe from venture studios where you
Mm-hmm.
get those shorter timeline exits, but those are still 3 to 5 years,
Right.
and it's a compressed timeline because of the environment that those ventures are built within and the associated resources that help facilitate those things. Um, what are some considerations that LPs should take when starting to consider some of these larger horizon? um, verticals.
Yeah. Well, I think you hit the nail on the head. I mean, it's a great example of, people think about time horizon differently. And is there something to be said for let's try to manufacture something? And I want to talk about that a little bit too, but I would say every LP, I think, who's thinking about venture in the context of a broader alternatives portfolio should have the sort of risk and return axes and map those out. And risk is a funny word. Like, what does that really mean? There's not a lot of volatility or real volatility in the private markets, given the number of times, the minimum data points you have for some of these funds and companies. But when you think about time horizon, like when do you expect liquidity? If liquidity is a priority for your program, you probably are underweight venture because that's just the nature of the beast. So I think going in with the understanding that this is, and when done right, that maybe be a little too strong of a statement because there's a lot of ways to make money, but when done more traditionally, early stage companies do take a longer time to get to that point where you're going to have that potential for an outlier outcome, which is the reason why most folks are investing in venture. It's rarely a singles and doubles game, and again, particularly early stage, it's thinking about those power law outcomes. So at the top end of what you can see here, you have to recognize that liquidity is not going to, it shouldn't be the driver, or near term liquidity shouldn't be the driver of why you're making that allocation. Now, as I mentioned, when you turn that back around, there are scenarios where certain models may give you the opportunity to generate some early liquidity, but there's a trade-off, right? It's, do you have enough juice left in the portfolio to get you to a level? It's a portfolio manager's game of when to sell things and really understanding the timelines for when investors expect capital back and when the optimal time. And these are not majority positions, right? So you have to work with the team, the founding team, the other investors around the table to understand and really align on what the right liquidity time horizon is. But for an LP, venture should be within the bucket of alternatives. Venture is going to be the longest duration or the longest time to liquidity. And you have to position it as such within the portfolio. If you need to lean into liquidity, reduce that allocation. If you are, I would argue in most cases, these are perpetual organizations with very long time horizons. You can take on some of that risk with the expectation that, again, if done properly, you'll end up with outlier returns.
So two questions arise from that. And first off, it sounds like communication is at the core of facilitating alignment, like with everything else in
Absolutely.
the world. So no surprise there. Managing expectations, clear communication, have transparency. That goes a really long way. So it's awesome to hear you say that. It's still interesting to me that is a novel characteristic that is sought after sometimes. Is just like this full on transparency, but there's a lot of power in it. I've learned that through my time in the world. In regards to the concept of manufacturing exits. So if you look at from maybe something like where you're forming strategic partnerships, you understand the play and the application of the technology, alternative considerations that might be in place, line up those relationships, help to facilitate those early on to kind of guide toward the M&A path. And then there is something else that, and I want to hear you tear that apart, please. And then there's something else that we've been considering lately as well, with the approach that we're taking. So our first fund, we're going to fully allocate, and then with the intention of spinning up a second fund, which will include follow-on and support for growth. And our intention was to have the optionality for a liquidity event for some of our earlier investors that might want out in the longer games that we play. You get your returns. They might not be those outliers at those earlier stages, especially with some of the future tech that we'll be working on. But you'll get nice returns, I'm sure. Mm-hmm. What does that strategy look like, or how has that been implemented? Where you kind of create your own exits within the organization so that you could support longer term?
Yeah, it is a very top of mind conversation, obviously for you, but also in the market. I think as the
Mm,
traditional routes to liquidity have dried up,
mm,
managers have thought about how do we manufacture this for our LPs. The pressure is, and I don't think it's inside baseball, but LPs may withhold a future commitment if they haven't gotten distributions back from that fund
mm.
manager. So you think about it in a continuous cycle, right? I've invested in two or three funds of this firm. I'm going to get the capital back, and then then I can invest in the fourth and onward and onward and onward.
Yep,
Uh, so if that hasn't been happening, there's pressure on the GP to manufacture some of this liquidity.
that makes sense.
So yeah, to your second point, I think we've seen a lot more of this, what's been called kind of continuation vehicles or single asset vehicles, where particularly in the more mature company space, the buyout space, where there may not be a natural exit for some of these companies and they're compounding at a very high rate. You may want to put them into a single vehicle. And what you do in that capacity, and this works in venture as well, you give your LPs the option of you can sell at an agreed upon price. Generally, there's a broker or a third party involved.
Mm,
So you make sure that it doesn't look, as a GP, you should be completely agnostic to the decision that the LPs
100%.
will make.
Yep.
There's some considerations, obviously. If you need to raise future capital to do that, you need to find folks to take them out. All this happens, I wouldn't say simultaneously, but it's all happening within the same process. So you can give the LPs an option to sell out. You can give an option to roll into a new vehicle, sort of the opportunity, this status quo option, where you still retain the same control or the same interest in that position or those positions, or you can give them an option to roll into the new vehicle and add more capital. So you give LPs. I found it to be empowering to be able to choose your own adventure to some degree with these assets. The argument can be made that the assets are of a high quality. The GP has identified them as top performers, and you can underwrite those to potentially a shorter exit from that point forward, depending on what's going to happen within those individual companies. There may be the scenario where you can continue to pour gasoline on that fire and accelerate growth. So again,
Mm,
another potentially positive outcome for some LPs who want to continue on.
mm.
But in a lot of the cases, it's an opportunity for an LP to get some of that liquidity back, hopefully at a very good price, and then continue to invest in new companies that will be pursued by that manager. So that's been, I think, a strategy that we've seen in a lot of cases. Is it much more in the buyout space than in the venture space, but popping up in the venture space now where you see some of those opportunities? Secondaries have always been available on the company level, but I think there's still an opacity to that market that a lot of groups are trying to clean up and make more transparent, to your point before, uh, to facilitate more transactions on an individual company by company basis. A lot of that
Nice.
does happen, but I think that those two areas are the spaces where uh, we're seeing a lot more activity and volume. And I should mention that sort of third area is this idea of a strip sale, where if you are a
Okay.
GP and you have a fund that is getting later in life, and you want to generate some liquidity, you can carve out a portion of your portfolio and sell that to a secondary buyer.
Mm,
Again, separately, privately negotiated transaction. There's usually a process involved. You can send capital back to LPs, but you can also retain an interest in all of those companies. So that's a
mm.
way to navigate the markets, generate liquidity, but not necessarily sell out of all these positions
Interesting.
in a pure secondary. So all those, there are more tools in the toolkit than there were a decade ago, and I think we'll continue to
Fantastic.
see advances there. But Andrew, your point about this manufacturing or aligning towards a strategic
Yeah.
outcome,
Yep.
I always find it. I think the best groups find we underrate who we're going to exit this to on day one. Of course, the path isn't always straight there, but I do
Sure.
think having a group and a cohort, particularly in the space that you're investing, the subset of buyers and you know where that demand is. So you
Yeah.
can use that to inform your entire investment strategy, and understanding where that buyer universe is. And then along the way, bringing some of that capital in to facilitate a cleaner exit on the back end, I think is a perfectly good strategy. I think It takes some of the guesswork out. And again, nothing's guaranteed, but it is a really nice, it's a thoughtful way to organize your investment strategy towards an exit even before you make that first investment.
That's great to hear. Thank you for that. I also would assume that it's a balance, right? Because on one end, we want to add diversity to consideration when we're painting the target. So we don't just have blinders on like, oh, it's this type of company. So these are the potential 3 to 5 that we should go after, sort of thing, and like just build toward that. But we always like to expand our horizons. We always ask what adjacent industries or their implications of the technology, innovation, or process, and what alternative applications. So we like to add dynamism to the businesses and considerations, which that in itself will help. But there's always a caveat when it comes to manufacturing exits, especially making those choices from day one. I'm assuming that it could also be detrimental to progress. If you have those blinders on and you're just focused on that one thing, could impede progress, could have negative repercussions to the business itself, or like either the model or the product or service.
Yeah.
If you keep those blinders on too tight. So I'm assuming just being cognizant of that and maintaining situational awareness as you progress is like the best thing that you could do for that, right?
Well said. I think the implication is not to be just narrow as like this company has to go here or it won't work.
Yeah.
I think keep it, particularly at the early stage, right? The amount of things that will change, business model, personnel, a lot of this can and will evolve and should evolve as the company matures. So that subset of potential buyers, I think, is also potentially going to shift.
Yep.
So keeping enough of an aperture where, going back to the idea of focus and what are you really good at and what business are you building, making sure that's going in a path where there are natural buyers. So it's maybe less so about I've identified the one group who I think this would be perfect for, and if that doesn't work, then I'm going to go back to the drawing board. But keeping in mind that you don't want to try to be everything to everyone.
100%. I love that. Keeping an aperture of awareness for the focus that you pursue. Love that so much. So amazing conversation so far. I'd love to dig into a couple more emerging manager topics since you're so deeply in the space right now. And I know it's going to be top of mind, especially given the market. So what is a good way for GPs to get the attention of LPs if they don't have like that core Rolodex to throw the stone in the pond and get that first round of introductions that then goes a few degrees out? What if that pond is really small and you don't want to be that business or service provider on LinkedIn that's DMing the pitch right out of the gate through InMail, and it's just flooding the inbox and it's just overwhelming. But more so, you have something of value. You genuinely believe that it aligns, done a little bit of research, right? It aligns with the thesis and the engagements that LPs would normally get into. So once you've identified that, what does that look like? So it's a little bit more welcomed by LPs and it's not a blemish on their day to get pinged. And then on the other end of that, how do you identify the right people to reach out to so that you can validate that information?
Yeah, it is I would say the main question I get from folks is around that. It's like, where do I find the fertile ground to go? I know I have a great story and here are the people I think would be great fits. How do I bridge that gap?
Yeah.
I think to your point, the cold outreach on a LinkedIn is going to be low probability. I wouldn't, I mean, there's a whole thesis around writing thoughtful, cold emails. And
Yeah.
I do think that will work in certain scenarios, but it can't just be a blast, right? You have to be
Yeah.
thoughtful. I always, when you're starting a fund, like the developing your ICP is almost the most important thing that you can do. Who is going to be the best fit for this strategy? And I think once you've identified those folks, it does come from network cultivation of who's in your initial orbit that you can use as a means to influence. Like that warm intro, I have a I am fortunate to have a number of people who have tentacles out in a lot of different markets, and they become
Sure.
that trusted inner circle where if they have seen something or heard something and they like it, it intrigues them. I am 75 to 100% likely to take that meeting when you
Mm.
get that. So cultivating that circle, it doesn't have to be a huge number of people, but the
Hmm.
likelihood is where you're starting. And if you're a specialist, if you're focused in an area, you hopefully have some of those folks who are already embedded. But same way, the way that we met, right, at a conference, you put yourself
Yep.
in situations where you are going to be in the right rooms and have your story cold, be able
Yep.
to tell that story in an elevator pitch type way. It's going to resonate with different folks, and in that capacity, obviously, you don't have as much opportunity to fully vet and prepare and know who you might run into. But I do think those are opportunities to test out some of these tactics. But I think that the best way, identify your ICP, really dig into your first ring of network, that trusted circle, and who can get an introduction there. And then feel free to go into a pond, even if you don't know if that's going to be fruitful. Hopefully, put yourself in somewhat of the right circles. I would say going to a venture conference, a broad venture conference,
Hmm.
versus for a strategy like yours, going somewhere where you are focused in areas like hard tech and space and things like that, where there is a little bit more alignment of the
Yep.
people who are going to be in
Yep.
attendance. At least the story is going to resonate, and you don't have to
Yeah.
start with a whole lot of preamble. But those are the two things that I think are most helpful. I ask a lot of managers like what kind of LPs are you looking for? What would be
Hmm.
the ideal LP? And a lot of them, tongue in cheek or realistically, are saying anyone with money.
Yeah.
That is not an untrue statement, but I do think you have to think a little bit deeper. For Fund One, maybe it's more broad, but you really do want to find folks where they get excited about your strategy, both from an initial investment perspective, and remember, these are relationships that are going to last a decade plus. So you want to make sure that the people who are investing in you, easier said than done, but are aligned with what you're
Yep.
doing.
Yeah, it definitely is balance. And to any founders who are listening to this, there's a lot of these same criteria and principles that are applicable um, to what some of the assumptions that I have around just general. Oh, try to find another word aside from decency, consideration when networking in general. When you're in a room, and we found this from not through the hard way, just through not so common sense. Um, it's all good to have a conversation with somebody. People are just people. Conversations go a very long way because you can actually connect with people on a human basis, and I think that's what progresses these relationships forward. Do have your pitch, but if you do it really well, um, you'll share a bit about what you're doing in a more natural way. Where if there's not alignment, you can still make a great connection. Um, so please don't again. Maybe any other emerging managers out there as well, but founders, please don't just arm yourself with the 30 to 90-second pitch and go to these events and find the five investors or the five LPs and just approach them and jump in and cold pitch and then wonder why nothing's working for you because
Yes.
it you will hit a stone wall every single time.
You said it. I think that the people part of this, this is a people business
Yeah.
fundamentally, right? Obviously, we're investing in potentially transformative, life changing technology
Yep.
across a lot of different vectors. But we're all at every step of the way, it's the human connection that's going to matter the most. And that's for me as an LP, I always think about it's a blind pool, right? We're someone who's investing in us as a fund manager, or when I'm providing capital to a manager, and I just have to. Obviously, there's history, but I'm investing in a person and a strategy, or people and a strategy, and that's where the bulk of my time from a diligence perspective is going to be spent, making sure I understand that person. So the more human you can be, I mean, it sounds funny to say, but the more real connections you can make with folks, it will. I don't think there's any downside to that. So just being able to do that, and I think the other thing is understanding that different LPs um, are going to like to be approached in different ways. So
It's a
don't
good call
think
out.
of, okay, I'm going to pitch to corporates. So here's the pitch that I'm going to do to them. Yes, there's commonality in their business, but the people are going to obviously look for something different. So one of the other pieces of advice I didn't mention earlier is be that listener. Be really turn up the hearing aid on a lot of these conversations, and don't feel like you have to be the aggressor and go out there. Once people understand what I'm looking for as an investor, I feel like they can make the assessment of this is probably a good fit. This is probably not a good fit. Let's stay in touch for the future, or really lean in and kind of go the extra mile with the pitch, with the details. The more you can tailor your conversation directly to that individual, rather than have it be kind of a blanket statement that may not be applicable, I think is also another really good way to approach it.
Fantastic insight there.
Mm-hmm.
Um, and then if you do end up finding, square peg round hole situations, that's fine. At the end of the day, make a friend. If the way that we approach things in every conversation and every potential engagement, and if you've ever had a conversation with me that started online, you will know this is true. Where I always say, let's explore alignment, because that's really what we're hoping to do, right? It's like, how can we bring value to the table, and have a mutual exchange? We want mutually beneficial engagements.
Mm-hmm.
So building those relationships, even if it's not a good fit, let's say a couple months down the line, you have a couple of founder friends that you could bring to the table, or VC friends that you could bring to the table and offer as value to these either LPs or investors. And you kind of you show up and you think of them, and you're adding value to your network in return, and that'll come back in. I don't know if recompense is the right word. That'll come back in return as things progress. Just seen it happen time and time again.
It is 100% true, that idea of paying it forward, of karma, whatever you want to call it.
Sure.
This is an ecosystem that's small, right? Even if you take venture as a whole community, it is a small network of folks that likely all know each other or will get to know each other. So the opportunity to have idea sharing, and also being able to serve as that role of connector, I find it to be one of the best parts of the job. And having now a bunch of different pockets, of diverse pockets, where people who maybe wouldn't have been connected before are connecting through me, right? That's a really good feeling. And
It's
like you said,
awesome.
Andrew, I think the idea that you can do that without asking for anything, right? Let's bring people together, and you get mutual benefit. Both sides of the equation get mutual benefit, and people will remember you as well. And I think that does go a long way. It seems like we're talking more about the psychology of the human nature versus the
Yeah.
actual investment, but it's a huge piece of it. It's a huge piece of being decent, being transparent, being willing to have a conversation, helping. And the one thing we didn't mention is this concept of authenticity, where I think that's
Mm,
a word that gets thrown around a lot.
yep.
But be yourself. Like, don't feel. There are many conversations where it feels robotic, or it feels like someone has researched the steps that they need to take in a sales pitch to get to the finish line. It's going to go a lot better if you are just who you are. You're back to the point of you're selling yourself as a person, uh,
Yep.
as a component of this overall investment strategy. So being true to yourself, I think, goes a long way.
I love that. And what are some of the considerations on the other side, right? So we've been talking about the manager side of things and considerations there. What are some things that would be valuable for LPs to consider when either seeking opportunities or intending to have these engagements? I've heard a couple of different either um, different types of LPs that even when I was out at live events, are like, oh, we're growing this new aspect of our portfolio. We're looking for deal flow. We're looking for opportunities. We're looking to meet these stealth emerging initiatives in XYZ vertical.
Mhm.
What advice might you have for the LP side that's looking to get connected, get out there?
Yeah, I think it's probably the same thing as a fund manager when you start ringing the bell and saying I have dinner here for everybody.
Mm-hmm.
People are going to come. So
Yeah.
I think being clear about what the initiative is. I'll
Mm-hmm.
give you a great example. At MetLife, we launched during my time there uh, a program focused on minority-led and diverse managers. And that was something when we made that announcement, the floodgates open up. So I think signaling to the market as an LP in a very clear way of what your criteria are, and then being ready, being prepared for what will be an influx.
Mm-hmm.
Because when these pools open, right there, to be the first person into those pools, it is a blank slate. So you have the
Yeah.
opportunity not to compete with 30 years of re-ups that you might have to consider, but you are potentially a part of a future program that has for a dry powder and something that you can help work with the GP, and they are, or work with the LP, and they're open minded. So I think that's the LP having a very clear strategy around what new program and initiative they're doing, making sure that that gets out into the right spheres, and then most importantly, being prepared to handle the inbound that come from that. I would say supplementing that, you should already have a pipeline of folks as you've developed this strategy.
Mm-hmm.
More times than not, it tends to be both an inbound, hey, we're seeing a lot of interesting opportunities, but
Yep.
can't execute against those, or we really see an opportunity here. We'd love to get more of this in. So it's generally a combination between those two.
Yep.
So that's a great way for those groups to kind of manufacture pipeline and handle that kind of flow. I encourage LPs to be creative, right? It's not easy in every context, right? If you're a public pension fund or you're a smaller institution, maybe it's a little bit more challenging to do some of these more creative things. But being open minded and not being afraid to go out on a limb and pursue things with high conviction. There's a great, guy by the name of Chris Duvos who runs Ahoy Capital. He's written a ton, great voice in venture. And the quote he always has is invest courageously. And I think that's a word where you think about what we're doing in the venture space. You think about the potential that's out there. It really has implications of being willing to take a risk, being willing to go out there and invest with courage. So I think as from an LP's perspective, I would tell folks, have a thesis, kind of develop that internally. Don't be afraid. I think a lot of people it is a very big groupthink market. And I think you have a lot of folks who are worried too about how they benchmark against certain peers. Who else is invested in a fund? That's usually a good signal when you have like-minded investors in there.
Mm.
But I think the best LPs are the ones who are willing to go at it alone. And I know many of those
Mm.
who build their own conviction, who aren't necessarily looking for another signal and are actually happy to be that first signal. So that's the two pieces of advice I'd say. One, if you have a specialized program, amplify it in thoughtful ways and be prepared. And then As you think about ways to invest in the future, be creative, be willing to take a risk and invest courageously.
I love that. And the other thing that I love that you've mentioned is like understand your thesis and really like embody it. And that gets me to think about, again, to tap into just the human experience. Surprise, surprise. And like psychology, identity is really having a manifesto of sorts. My partner Chris hates that word, so I GPT'd it in the background. Say credo or proclamation, along with 15 other synonyms.
Sure.
But understand, truly understand why you're doing what you're doing. This can apply to anything, right? And I think I'm speaking to myself and to the manager crowd, where you can effectively not just articulate but emulate the reason why you're doing a thing.
Yeah.
Because when you can do that, decision making becomes a lot easier. You actually have criteria and not a checklist that you run down, which are like quantification driven, yes, no answers, but more so like true alignment with why you're doing a thing.
Mm-hmm.
And I think that goes into like the thesis versus like your internal thesis of why you're going about it. And I would assume that would allow you to take any kind of action or decision making, regardless of the level of risk, because you've identified your risk tolerance in that kind of threshold a lot more courageously.
Yes. Well, Andrew, it's funny you say that too, because I think there is, when I think about underwriting a manager, I
Mm-hmm.
always say there's the who, what, where, when. Those are
Mm-hmm.
data points, right? Those are
Yep.
things that I care about. I'm going to write down. They're relatively straightforward, right? There's not a lot you have to, the what maybe you have to dig into a little more. The question that matters the most is certainly how, but the why, right? The why is really what drives it home. And it's in reference to historical investments. Why did you do this? Why did you take this action when you saw this pattern of behavior, or you saw these, this happened in the market? Why? You continue to ask that why question. And where it really culminates is the motivation of a firm to exist, right? And it's funny enough, you can ask people that direct question is like, why are you doing this? We talked about it before. Is like, why do you get into this business? It's hard. The success rate
Yeah.
is low.
Yeah.
It's going to take a long time to generate what will hopefully be really good outcomes. So you have to really feel that alignment, to use another word that you threw out. I think just bringing all that together. And I have to be able, as an investor, someone who's willing to put capital into a manager for a decade, and trust you to manage that in a good way. I have to deeply understand the why. And
Makes sense.
that's where every pitch I think should start. It's like, here's why I'm doing this.
Mm.
And that's, some of the advice that I provide to a lot of emerging managers is around nail your why, right? Certainly upfront, tell me the who, what, where, when. You can probably do that in
Sure.
a slide or
Yep.
two,
Yep.
but make sure you nail that why, and then not just why you're pursuing this strategy, why this market, why this time. Like, you can really elaborate on that, and the more meat you can put on
Mm.
that bone, to your point, it inspires yourself. It gives you that true north of, here's really why I'm doing this, and everything's going to come back and pull back to this.
Yep.
So not only does it help in articulating it to external investors, it helps you ground yourself into what you want to do best.
Yeah, and I think even when we're looking at founding teams that are approaching some of the most challenging, complex problems that we've yet to solve. That's one of the things that we look for, because it is a signifier of resilience, and we know that they will persevere through the intensity that it's going to be required to bring
Yes.
some of these things to life.
Very good word choices there. I think the word resilience is something that it's hard to quantify. It's really hard to
Yeah.
figure out like who
Yeah.
has that, but that is something we always look for. Grit is another one that we use a lot.
Mm,
Like it's those couple of things of how do you, what are the different tactics to be able to try to assess that and tease that out.
awesome.
Again, not easy, and there's no one set of questions that you can ask to pull that out, but it is definitely something that if you and I were to meet somebody, we could both maybe
Hmm.
have a different perspective
Yeah.
on what that founder's resilience or grit might be,
Yeah.
but definitely something you want to try to measure.
And actually, on that note, and kind of to touch on the groupthink that you alluded to earlier, and then touch on kind of this analysis of opportunity, and then bring in a little bit of things that we've talked about in past Building in Public episodes on diversity of perspective and thought. What are some recommendations that you have for creating a small council for yourself, whether it's an official within the
Mm-hmm.
organizational infrastructure or just your personal network when it comes to decision making? What are some considerations that you would recommend to bring multiple minds to the table for decision making so you get that additional perspective?
Yeah, it's a really great question because it brings everything together, right? And
Mm.
I personally, I think over time it naturally happens, right? So it's the people who you spend time with, uh, having been on the earth for 4+ decades. That's
Yeah.
one of those things that
Yep.
people come in and out, but you naturally
Yeah.
self-select into those folks you trust the most. But I think you said it. It's diversity and not a yes person, but a no person. You kind of want a red
Mm-hmm.
team within that, somebody who
Mm-hmm.
is a natural skeptic who's going to look at everything you're doing and push you to think about that in a way that maybe you haven't before, challenge you in a way that is respectful but strong. Like
Yep.
you should pressure test most of the ideas that you have in our context as we talk about from
Yep.
a fundraising capacity, probably less so in a personal capacity, but I do think with an informal council
Yep.
or advisors, mentors, it's a
Mm-hmm.
role I get to do a bunch now, which is great. But you take on different roles. One is I'm just here to listen. One is I'm here to challenge you at every step of the way. One is
Mm.
I have very particular experience and I can help you with a laser focus on this particular area that you're trying to build out.
Yep.
So I think you have to almost put archetypes around what type of people you want in that circle. But the
Mm.
overarching theme is you don't want people who are just going to be your cheerleader. You probably need one of those people in there,
Sure.
but you really want people who are going to bring a lot of this to the table. The ways to generate that, obviously, the natural network, but also seeking folks out who have that particular experience, who, there may be, and I'll use kind of you as an example, there may be a vertical that is of high interest for someone like me. And, if I have a question about that, I might come directly to you for that particular point experience. So it's constantly back to what you said before, constantly putting yourself out there and
Yeah.
knowing that even if we don't have a business transaction out of this, there's a potential that we could collaborate. We can be mutually beneficial to each other in this kind of advisory, consultative arrangement or construct.
Yeah. 100%.
Mm-hmm.
So to repeat that back, and I think there's an assumption there that's good to surface for anyone that values being um, deliberately self-aware. um, God, I hope that didn't sound as condescending as it sounded coming out of my mouth. But like really, like there are things a rhythm that we fall into in life. So it's really easy to have your network and your group of professional friends and business your business circles, and that it can happen organically, and there might be some conscious choice around who those people might be. But be aware that the circles that you surrounded yourself with might not have been deliberately constructed as
Sure.
well, and make sure to reflect on these points, right? And identify the archetypes and construct valuable feedback loops for yourself in the different uh, realms that you're engaging in the world, whether it's investing as an LP, investing as a GP, being a founder within a startup, or really anything that you're doing in life. But I love that identifying who would be valuable to have in place, having your red team. I love
Hmm.
the
Yeah.
terminology.
Hmm.
I've seemed to have been naturally doing that because I do value the feedback, the pushback, the alternative perspectives of critical thinking, because I am an optimist. I'm a visionary, or as Chris likes to say, I'm the golden retriever of the team, which is awesome to be
Yes.
enthusiastic about the future. We could do anything. We can, but you can't just do anything because you think you can do anything. So it's great to have different people in those different roles and with a different either industry specific experience or skill set specific experience. So what I've seen people do, even outside of the small circle, and like some of the aspects like an LPAC or I don't know what the version of that is for LPs. It's probably just a network or community.
Hmm.
Um, but like Amish, we had Amish from Conduit Venture Labs. Um, we had a great conversation with him. Definitely check it out. But that's one of the key things that they built from the very beginning is their fellows program,
Yes.
and they actually engage them. That's what we're doing with the Future Council, where we're bringing on industry and skill set specific experts. So we have one place where we can throw a stone and have perspectives that challenge and validate and compress into this.
Yeah. Well, to that point, Andrew, I think that is the best way to do it. A quote I always like is no one is smarter than everyone. So the more folks you can engage around a particular topic,
Oh yeah.
I think we are in an industry where there is a lot of ego, right? I think there are folks
Yep.
who do lack self-awareness, and
Yep.
maybe are unwilling to ask for help. And I think that's
Mm.
not an indictment personally. I do think that is part of, you're willing to go at it alone, and you're willing to be off on an island
Sure.
and kind of run at something.
Yep.
So I think of those types of things. If you can flip the script and say the most successful folks have formally or informally a group of incredibly smart people around them that give them what they need to accelerate where they're going, and that's where it's going to look different for every group, and that the type of feedback you need, the type of person. So it's incumbent on you to figure out what that looks like. But I would venture to wager that if you decided to go at it alone or with a group, I'm going to guess that the group's going to win almost every time.
It's really interesting, actually, in regards to the team side of things. Just saw pop up this morning on my LinkedIn feed a video of Stephen Bartlett speaking about an interview that he had. There's some meta for you. An interview that he had with Walter Isaacson, who did the biographies on Steve Jobs and Elon Musk. But he was having a conversation with Steve Jobs, and he's like, "What's the best product you've ever built?" And he said, "The team, the core Macintosh team, because they are the source of all the brilliance thereafter." And I think that really reigns true um, with kind of that curation.
Yeah, it feels good to give credit, right? If you're around folks,
Oh
that's
yeah,
the other piece too. Is I wrote something not that long ago about gratitude, and
nice.
one of the things that uh, we did at Allocate, I think a lot of
Mm-hmm.
groups do it, in a retro. You have a shout outs section of this where you
Yes.
make sure you identify all the people who made positive contributions. It feels good for the individual to be recognized in a group setting,
Yep.
but you recognize that is a human emotion that needs to get tapped into in environments that can be stressful, that can be very
Yep.
fast paced, and you forget about the things that people have done to contribute to the overall success.
Yeah.
It's the forest trees kind of argument. Like if you're
Hmm.
constantly looking at that big dream, that's great, but you need to understand that there is a lot of little things going on. It's so cool on the jobs point where that's just like the product, right?
Yeah.
Is the people, and
Yeah.
that's I think a long way or a great way to think about it.
Yeah. 100%. I love the call out on gratitude as well,
Mm-hmm.
especially from a professional standpoint, doing so authentically, and
Yes,
really recognizing people will go a long way because we have a tendency to take things for granted when you get into that motion of moving forward, right? But it is all of the combined hard work that brings these great things to life. So
we are
shout it
we
out for
are
sure.
we are bridging the gap between the personal development and the
Hundred
professional
percent,
development. This is great.
100%. We'll create a new industry, venture development.
Yes.
No, that'll die right there. But I mean, just from it's a human experience, right? So like, just be a decent person and want to improve and want to get better. That'll take you very far in life. And if you imbue that through a lot of the professional principles, I've seen that provide
Definitely.
quantified returns.
For sure.
Yeah, literally and metaphorically.
Couldn't agree more.
Awesome. Thanks, Matt. This has been a fantastic chat. Do you have any closing thoughts or anything you want to leave the audience with?
Yeah, I mean, I agree. This is awesome. I think you're a great counterpart to do this with. I love having the conversation. I think the one thing I would say is that back to the human side of this, having now spent 21, 22 years kind of in these various seats, being able to pull back and look at how this ecosystem has evolved and
Hmm.
developed, and recognizing there's something so special about being in this asset class. Uh, Private markets, I think, was opaque. It was unknown for a lot of people for a long period of time, and it still is. There's an opportunity to bring this to more folks and the opportunity to consume content and to become more educated. I think there are regulatory walls that need to get broken down and structural walls to make this more accessible.
Mm.
But I do think it's a place where if you're an intellectually curious person, uh, whether that be someone coming through high school, undergrad, there are a lot of ways to express different parts of, or lots of ways to express in this market with different skill sets in different
Mm.
ways. So I've been fortunate. I fell into it completely backwards. Didn't know what I was getting myself into, and it's like once you get on the ride, you don't want to get off. And I've been really lucky to experience it, and would love to share it with anybody else.
Beautiful. I love that. And thank you. So in that regard, and for the people that do want to reach out and get in touch, what is the best way and place for them to do that? We'll drop links below and everything, but
Yeah, absolutely. LinkedIn is probably the place where I'm most active. So that's a place where anybody can reach out. I
perfect.
can't promise I'll get to you immediately, but definitely a really good source. I try to post, on a pretty regular basis, a lot of my thoughts on the market and things that are going on.
Nice.
So always a good place to connect.
Maybe we can get together and use each other as motivation to finally spin up newsletters on our own regard, because I would love to follow a newsletter that you've maintained.
Absolutely, it's in the backlog for
Yeah.
sure.
Yeah. Not to add something else to your plate.
Very cool.
Awesome. Well, thank you again, Matt. It's been an incredible conversation. Thank you to you, the listener, for tuning in. Drop a comment somewhere and let us know what the most thought provoking or interesting topic of the conversation was. That'll be
Excellent.
fun.
Awesome.
But in the meantime, have a good morning, good evening, or good afternoon wherever you are in the world, and uh, catch you on the next one. Cheers.
Awesome. Thanks, Andrew. Thanks, everybody.